story on Wall Street has changed so dramatically that if you've been paying attention over the past 2 years, you're probably wondering how we went from constant warnings to full-on optimism almost overnight. For most of 2024 and the beginning of 2025, the mood was heavy. Analysts kept telling everyone to prepare for the delayed punch of high interest rates, to expect the AI rally to fall apart, and to brace for consumers eventually slowing down. It felt like every headline was preparing us for some sort of storm. But as 2025 comes to an end and investors start looking toward 2026, it feels like the entire narrative has been tossed aside. Big institutional banks, the same ones that had been sounding cautious for so long, have suddenly flipped their tone. And not just gently. They've gone from saying, "Be careful, a recession is coming," to practically shouting that a new boom is on the horizon. Morgan Stanley, JPMorgan, Deutsche Bank, Goldman Sachs, Bank of America. Almost all of them have made some kind of major bullish shift, one of the most synchronized and dramatic ones we've seen in years. The recession they kept warning us about never arrived. And now they're saying something far more surprising. Not only did we avoid the downer, but 2026 could actually be the beginning of a powerful new bull market. We're not talking about mild gains. Several banks are expecting the S&P 500 to rally strongly, potentially delivering double-digit growth. Instead of questioning whether the market can keep rising, many of these forecasts are treating higher levels as almost inevitable. If you look at what each bank is predicting for the end of 2026, you start to see just how dramatic this shift is. A level like 7,000 on the S&P, which used to sound like a bold dream, is now being treated as the starting point. Deutsche Bank has taken the most aggressive stance, suggesting the index could reach 8,000 by late 2026. Their reasoning is that earnings growth is finally becoming broader. It's not just tech giants carrying the market anymore. They believe that once the Federal Reserve begins cutting interest rates, other sectors like industrials, banks, and manufacturers will start participating in the rally in a much bigger way. Morgan Stanley's shift might be the most shocking because the firm had been one of the loudest bearish voices for years. Their analysts are now saying the index could hit around 7,800. They argue that there's a combination of factors working together in a rare moment: looser fiscal policy, an expected cycle of rate cuts, and a fresh wave of deregulation. They especially highlight the huge corporate tax legislation that's expected to free up more than $100 billion of corporate money. That's money companies can use for expansions, dividends, and share buybacks, all of which fuel stock prices. That JPMorgan is also painting a very strong picture. Their base case sits around 7,500, but they say that if the Fed becomes more aggressive with rate cuts, the index could easily rise toward 8,000. Their whole perspective hinges on AI. Instead of treating AI as a bubble that will eventually burst, they see it as a long-term productivity wave. They believe 2026 is the year we'll finally see the real payoff, when companies outside of tech, like banks, retailers, energy companies, and healthcare, begin seeing major improvements in efficiency and profitability thanks to AI tools. Goldman Sachs is a little more reserved, but still optimistic. They see the S&P finishing around 7,600. They think the short-term outlook is bright, driven by strong corporate revenue and a resilient economy. Their long-term view is more cautious because valuations are already high, but for the next year or two, they think momentum is very much on the side of the bulls. Bank of America is the most conservative of the group. They're predicting something closer to 7,100. They still believe the market will rise, but they warn that there may be a moment in which earnings growth slows down before picking back up. They're basically saying, yes, we're in a bull market, but don't expect everything to go up in a straight line. When you take all these forecasts together, you can see a clear pattern. Something has changed. Wall Street isn't nervous anymore. It's confident, much more confident than anyone expected. Why the sudden change of heart? Why did these same banks spend almost 2 years warning us about a hard landing, only to turn around and say we're entering a new boom? It comes down to 3 forces that are coming together at the same time. The first is interest rates. For nearly 2 years, the stock market felt like it was fighting the Federal Reserve. Rates were high, borrowing was expensive, and consumers were expected to slow down. Now the direction is finally reversing. Inflation has cooled steadily throughout 2025, and the Fed is signaling that it's getting ready to cut rates several times in 2026. That alone changes the entire tone of the economy. Lower rates make it cheaper for businesses to borrow, expand, invest, and even survive. They also make bonds less attractive compared to stocks. When rates fall, big pools of capital start flowing back into equities. And this is exactly what big banks expect to happen in 2026. The second major factor is the new fiscal environment. The large tax package, nicknamed the One Big Beautiful Act, gives companies wide tax incentives and relaxes certain regulations. That means companies will pay less money to the government and keep more money on their balance sheets. When you give corporations more cash, they usually respond by investing, hiring, buying back shares, or raising dividends. All of those things boost stock prices. And Wall Street absolutely loves business-friendly policy. The third factor is AI finally proving itself. In 2023 and 2024, AI was mostly hype. Investors bought stocks like Nvidia because of future promises rather than present earnings. But big banks think 2026 is the year where AI adoption becomes real. Not just for tech giants, but for almost every sector. Retailers improving logistics, banks optimizing fraud detection, healthcare companies speeding up diagnostics, manufacturing companies reducing waste. Small boosts in efficiency across many industries add up to major profit expansions. JPMorgan calls this the beginning of the AI productivity supercycle, and they see it helping stabilize earnings even if certain parts of the economy slow down. Now, to understand why the banks are suddenly so optimistic, it actually helps to understand why they were wrong in the first place. Their models assumed the economy wouldn't handle high interest rates for long. They thought people would run out of savings, that companies would crumble under rising costs, and that jobs would be lost. But several things happened that their models didn't account for. Most American homeowners have long-term fixed mortgages at very low rates, which means rising interest rates didn't increase their monthly payments. People continued spending. On top of that, companies had refinanced their debt during the pandemic at historically low rates. So even when borrowing costs went up, they weren't immediately affected. And finally, the job market never cracked. If people keep their jobs, they keep spending. That simple fact kept the economy alive and prevented the recession that everyone was expecting.